Hello again and welcome. This is Robert Schein, Managing Director and Partner of Blanke, Schein Wealth Management. Thank you for joining us on our Thursday edition of May 19th, 2022 of our Market Insights and Observations. Let's get right to it. Yesterday was anything but favorable in the markets. In fact, everything basically, just all 11 sectors, the S&P 500, the Dow, the NASDAQ, and the S&P all sold off from 4 to 5% respectively. So the sell-off continues. Well, yes, we are in a bear market territory. Technically not in the S&P, but give it a week or so, we probably will close in bear market territory. Remember, bear market territory is down 20% and a close within that. But we had that well over, 27% for the NASDAQ and the Dow itself. So we are in the territory. And what's actually happening? Well, what's happening is this struggle, this power struggle that we're seeing with interest rates and the Federal Reserve trying to control sort of the velocity of money, if you will, within the economy. By what they're doing is trying to raise interest rates. In fact, the short-term interest rate by all accord are rising. Anything from mortgage interest rates to the Fed funds rate, that they're trying to raise interest rates as quickly as possible. Robert, why are they trying to do this? Because inflation is running rampant everywhere. As we saw, big box retailers yesterday really got caught off guard in their earnings reports. They talked about how the diesel prices, the input prices, the supply chains, and their ability or inability to pass it on to the end consumer. So ultimately, what we turn to is the Federal Reserve. What is going on? Because they are way behind the curve here. And I keep saying that, and the markets keep sort of every day keep proving that. And what has to happen? Interest rates have to go up quicker and faster than actually what they're actually doing. Now, if you watch and listen to what the Federal Reserve Chairman said last week, or even the Kansas City Fed President Esther George today on CNBC, both have indicated what the Fed's action plan and game plan is going forward. And ultimately, it's going to be a Fed-induced recession. Let me say that once again. The Fed is going to cause a recession intentionally to ultimately break the back of inflation. That's really their last resort right now, and that's what the markets are interpreting. Basically, if they do that, and when they do that, and they're going to do that by raising interest rates quicker and faster. Ultimately, that means that they'll do the work on the front end. They'll cause slowing in real estate. They'll cause slowing in all of the energy and a few others, because the consumer is going to get hit and the consumer is not going to spend. We already saw consumer discretionary down over 35-40% year to date in that sector alone of the S&P 500. So that's a precursor to what we saw in the big box retailers. The consumer essentially is going to say, no, there's going to be a buying strike. There's going to be a recession. There's going to be companies that are going to start laying off again to preserve the bottom line. Again, that's how earnings are preserved. So once we have a tilt in the economy, then we can see the Federal Reserve doesn't have to raise rates as much. They can go from hawkish to accommodative, or at least, at the very least, neutral. But we're ways away from that. But keep in mind, the stock market, the equity markets are a 6-month plus discount mechanism of basically forecasting what it sees or what it fears in the economy. And oftentimes with markets, they overdo it one way or another, especially on the upside as well as the downside. And we could see some extremes on the downside right now. Tremendous valuations. We've got some cash to put to work for our clients. So we're a balanced, diversified. We own quality businesses that are well run, that, if you have a longer term time horizon, we're all going to be in a good spot. But in the short term, you have to go through today's lower prices. Again, markets are on sale to get to tomorrow's higher valuations. And this ultimately, that's the struggle that's playing out right now. And so let's look at the Fed-induced recession. So what has to happen? Well, they're trying to tackle inflation right now. And how do we know? When do we know that inflation is ultimately peaked? Well, you'll see energy prices peak and material prices peak. And both of those are super hot right now. And once those will peak, and that'll give us indication that inflation is actually rolling over. There are some aspects of inflation, like used cars, that's rolling over, and other aspects with housing is still super hot right now. But I had a good call with a client and a great business owner here locally, and she runs a mortgage company, the best in the valley here in Palm Desert, California. And she talked to me and said, "Hey, Rob, just so you know, looked at the MLS this morning, and over 50% of the MLS in the Coachella Valley right now has price reductions." So housing is slowing, and that's what the Federal Reserve is trying to do, which again one of the legs of the economy that's running rampant, inflation, because increased real estate prices are out of control, is by raising rates. And that's what they did ultimately. And you saw the 10-year Treasury go up this year, but you also saw mortgage rates go from the mid threes to the mid fives in just 90 days. And so that's slowing mortgage demand, that's slowing housing. And you're also seeing price expectations come back to normal, because over 50% now are on sort of coming down in the real estate market. Now, that doesn't mean real estate's going down any time soon, because it's a supply issue. If you look at existing home sales, the supply is only a 2.2 month supply, because the tight supply is adding to the pressure on home prices. But also keep in mind, housing affordability is going down. And so that's going to be more drag on the consumer, more drag to corporate balance sheets, if you will. And that's where the struggle is real right here. So we will find, is pricing pressure going to have an impact, or at least slow some of the real estate? We potentially could see that. I think that's playing out right now. I think that's part of the Fed's plan to, again, have a Fed-induced recession. So they're ultimately going to try to put the economy in a coma for a soft landing. I don't know if that's going to play out too well. Now, the bear market sell-off, Rob, are we there yet? No, there's more pain to go. We still see some more sort of downside potentially. We'll get some rallies here and there within the bear market. Clearly, that's where we are right now. But what we're watching for internals to actually turn the tide from a negative sort of selling trend to a positive selling trend, ultimately we have to have three things that line up. Now, it doesn't happen every single time, and it might not happen this time for us to put in a bottom here. And we're closer than we were even, the start of the year for sure. But we have to have the put-call ratio close to 90% reading or higher. We're getting close. We're at 85 right now. The VIX, the volatility index, we were close to that last week in the 35 range. We're still in the low 30s right now. We need that to get above 40, or at least touch 40. That's a healthy indication, historically speaking, that you go all in, and when you hit the VIX at the 40, it's a great time to buy. So we're not there yet, and it's a good sort of inflection point for markets saying, hey, listen, selling's done. Now, another indication that we are there yet, or we are actually checking the box, which is one of the three, in terms of a bear market scenario here, to say, hey, will the trend turn from negative to positive? Well, it's the trend index, or the New York Stock Exchange index, and ultimately it has to have a reading above 3. We're well above that right now, and ultimately it's an overbought, oversold condition. So we are definitely oversold. Anything above 3 is a extremely oversold position. And we were at the 3.5. So it's a positive reading right there as to a bear market playbook. Signals we see on the dashboard to say, hey, listen, when will the trend change and the tide change from one to the other? So we're getting close. We're not quite there yet. We're seeing some of the bigger names sort of get taken out to the woodshed, but they're good quality companies. Earnings, and believe it or not, S&P earnings are still up for the year. Earnings reports are coming up. And we still believe we will have a higher year end. So that's why we sort of get through the periods of time like this. But again, we're here for you at Blanke Schein Wealth Management. If you want to discuss, you have any questions, comments, concerns, or if you have some referrals. We received a lot of referrals last week and a half, and we appreciate that. That's a testament to what we've been doing for you. And we're keeping busy every single day. So thanks for watching.